Welcome to the Collecting Keys Real Estate Investing Podcast with your host, Mike DeHaan and Dan Austin. From wins, losses, horror stories, and tactics for optimizing your business, Mike and Dan take a real, uncensored deep dive into the ins and outs of running a full-time real estate investment and wholesaling business.
What's going on, guys? Welcome to a spontaneous episode of the Mike and Dan Show for our YouTube channel. We were just talking about the housing market situation as of April 20th, 2022. I just realized it's 420 today.
Oh, is it?
That's how far I'm removed from that culture. I didn't even realize it until right now.
Man, we better shut this off and go to the store real quick. Be
Go to
way better episode.
The greenery store. And you know, it's been coming up everywhere, obviously. Rates right now are getting up to if you consider points. So I was looking at a mortgage rate this morning in our morning meeting. If you get a 30-year conventional loan and you have, like okay credit, like 7 to 740, it was the basic quotes I was seeing were 5.6 to 5.7% after a 2-point buy down. Right, so
which is wild. Yeah. And I was actually, after you talked about that this morning, I looked at the Fred website. For any of you that don't know what that is, that's actually a great website for looking at any kind of financial data. It's actually super crazy. You can go down a rat hole there, but they were at 5%. And you can see there's a dip from 2018 until now. 2018, it was kind of in that ballpark area. And now they're back up to there. And obviously we're expecting them to go a little bit higher still.
Yeah. I know
A little bit, a lot. I don't know, but a little bit for sure.
Yeah, it's so weird, and people are always comparing it to 2008, of course, because that's the one housing crash that everyone alive remembers.
It's LeBron James and Michael Jordan argument, right?
Right.
The two most recent badasses. Like nobody talks about Wilt Chamberlain as much anymore, but it's always LeBron versus Michael.
I think it's a perfect example because people that don't know anything about basketball, they know who LeBron and Michael Jordan are, and most people, let's be honest, know literally nothing about real estate. Like all they know is that means that you buy a house or you sell a house, and that is the extent of their knowledge of real estate. They don't know how transaction works. They don't know how the greater economy affects. They don't know any of that. But people are always making that comparison, and it's. I understand why people say that because of how the prices and things have gone up so much. But if you look at the big picture, like I don't even know what to think because I was looking at this. This report today, or was it today? Maybe it was yesterday. And it was talking about like right now versus 2008 in Spokane, where we live. And it was like back then there was like 5,000 houses on the market in Spokane when the market crashed. And so like there was a huge amount of like
lots inventory.
Yeah. But like so much inventory for the prices to drop. And as of yesterday, there was 182 houses.
Which is wild. Spokane. Like that's nothing.
Like that's not even a comparison, right? That's what 2%, 1%.
And it's interesting because there is a lot of new builds going on in our market, and I think other markets are more indicative of like massive new construction, like especially in the what do they call it, build to rent markets, where you see that. But like, there's not like when I remember being here in 2008, you could drive around and throw a stone and you'd find a builder building a house. Even small time builders would have 2 or 3 projects going on at once.
Yeah, and you don't see that really at all right now. I mean, there's very specific areas that they're building, but it's hard to build stuff here.
Yeah, it is. There's some more and more apartments coming in, but we have national home builders here, which we've never had in the past. And even so, there's not a lot of new construction going on, citywide or countywide. It's in like the pockets where it's like, oh, there's a piece of land, and we have a lot of land available. It's just not developed. You can't develop it yet.
Yeah,
which is maybe a good thing right now.
Yeah, maybe. I mean, the big question just comes down to with the prices and with the the interest rates being so high, the affordability dissipates so quickly. For primarily for new home buyers, though, this is one of the things that I think gets overlooked a lot. Is everyone's like, well, who's going to be buying houses when they're this expensive? I'm like, well, if you haven't bought a home yet, not you, unless you can afford like a much more expensive home. But people that are looking to sell their homes, moving to something else, they're going to be able to sell their house that's doubled in value over the last couple of years and walk away with a huge amount of equity, roll into a more expensive house, and still have a reasonable payment. Someone's moving from a house that they bought for 200 grand and, just sold for 400 grand. So I mean, pulling out, let's say 250 after the equity gain and their money that they probably put down on it. They can use that and roll it into a $700,000 house and still have, probably more expensive payment, but they're going to have decent money to put down on it and keep it somewhat under control.
Right.
It's the people that are going around trying to do like 3% down loans that are just completely screwed.
Yes, I think so. So I'm looking at the Fred economic data, which is the St. Louis Fed website.
You should share your screen.
Oh gosh. Okay, let's do it.
It's at the bottom.
All right.
A few moments later.
All right, so yeah, I'm sharing here the St. Louis Fed websites, the economic data. It's fred.stlouisfed.org. Great website. Any financial data you want. I learned this in my economics class. I love this website. You can go down some rabbit holes.
It's when you got your fancy pants MBA.
Yes, this is the one takeaway I got from that 2-year education, besides all the friends I made. Anyhow, so if you look at these gray bars, those are typically showing when there were economic downturns, recessions. This gray one over here is the 2008. So if you look at it, right before that in 2007, 6.63 was the 30-year fixed rate mortgage. And today, if you look over here, it says 5%. So if we go back over here to this graph, this is where we're at. And, this is the 80s everybody talks about. And then the Fed chairman had to push us into recession because interest rates were so high. So they turned the federal funds rate really high, right? And then that slowly brought down all the mortgage rates, and they were still high, right, in the 90s. So what we're talking about is interest rates, right? So we're still not where we were pre-2008 recession, but we're probably on a path to get close to that, right? If we're at 5% on, and this is aggregating all the data, right? So you're looking at quotes, this data is probably not as up to date as like getting a quote right now this minute, right? With points, but this is, I believe, what people are paying on average right now. And so with multiple Fed rate hikes, this is going to get to that. So we have higher interest rates similar to going back to pre 2008 rates. And we have crazy ass appreciation, which we also had pre 2008, right? But those are only two of the data points is what you're getting at, I think, right?
Yeah. Well, I mean, something that one of the challenges with dealing with the average person when it comes to talking about the economy in general, especially, the media doesn't help with this either because they fixate on whatever's going to get clicks, right? Which for so many people is housing, and, real estate, especially because there's such a housing problem in the United States right now. And, people, when they hear interest rate, they think of housing and mortgages because that's literally their only experience doing their own personal life experience in anything revolving an interest rate in their entire life. So maybe a credit card, but that's consumer debt, right? It's very different. And so people think that recession, inflation, all that sort of stuff is just going to cause a major problem in the housing market. But realistically, there's no guarantees at all. Even if we do go into a pretty heavy recession, that housing rates would tank. I mean, like, I think if anything, people are just going to stay put, and housing markets are just going to stay like exactly the same for
what you're saying,
period of time.
What you said too is like last time this happened, if you want to do the Michael Jordan, LeBron James comparison, was 5,000 houses on the market right before the crash. We have 100. So how quickly are we going to go from 190 something houses to 5,000 or 7,000? Probably not overnight, probably not really fast. And I think and I guess here's what I'm going to preface all this with is, if you're a real estate talking head, most of them are saying the housing market's not going to crash, I'm going all in. It's like, yeah, that's your business. You want it. You if you talk like that, you hope it's going to continue to go up the way it has because that's how you've built your wealth or whatever. And then there's some other talking heads that they're kind of like the inflation hawks and all these people saying it's going to crash. It's going to crash, and this is why it's going to crash, right?
It's because they want to generate fear. And like that's like people's biggest fear is that they just overpaid for the house, which honestly you probably did. Let's be honest. And
in relation to a specific data point, you overpaid for it, right?
Yeah.
And not all of the data points, but there's certain things when you say like when I bought my primary residence a couple years ago, I felt like I overpaid for it. Today, I
Yeah,
feel like a genius,
I
right?
know. I
so
know.
so like I think there's macro data, and I bring that up just by saying like my true answer is like I don't know. I'm gonna keep investing in real estate. That's what I do. I enjoy it. That's what my business is built on, and that's where my area of expertise is. So yes, I'm gonna continue to invest in it. I'm gonna continue to invest in it smartly, and as
Mhm.
best as I can. But what I'm saying though is like we have a couple other things that are outside of interest rates and appreciation. One being an inventory issue. Now, there's arguments on both sides that we are not underbuilt, but the main argument you see in the media is that we are underbuilt nationwide. I think it was like $3 million, 3 million homes or something like that
Mhm.
last time. So
Yeah.
that's a big issue, and we do see that in our home market. What you're
I
saying
think
is
in any market right
right.
now, like I don't think there's a single market out there that doesn't have the same issues.
Right, and even the Midwest is appreciating beyond what anybody could have ever thought
Yeah.
of, right? But the other conversation you and I were having earlier today was about liquidity in us personally, and then also the people we network with. Would
Mhm.
you agree that there's a lot of cash on the sidelines, not because people are choosing to put it on the sidelines, because from my experience, they desperately want to deploy it because there's been a
Mhm.
huge cash infusion, which has caused inflation. And people have done pretty well for themselves the last decade. And guys like you and me, we have cash, we have liquid cash that we are actively always looking to deploy somewhere. And there's
Mhm.
people much bigger than us that also have that same issue. And people we
Yeah.
talk to are looking to deploy their cash and they want to find good investments.
Yeah.
That's
I
why a
mean,
lot of syndicators exist right now because people are willing to throw money at them.
at anything, right?
Yeah.
And yeah, I mean, you're completely right. If there's, and I mean, that's the biggest thing is just that wealth gap that's growing because, there's so many people that can't even afford to live right now. Then there's
Right.
honestly a lot of people like us who are sitting on a lot of cash or have
Mhm.
generated a lot of wealth for themselves just because they, made better decisions or they were able to get
Mhm.
into a housing market,
Yes.
over the past 10 years. I saw this stat the other day and it was like there was 300 more, 300 the 300 I don't know if 303,000 new millionaires in the United States every single day in 2021,
Wow. That's
right?
amazing.
And a huge portion of that is because people's houses that they
Mhm.
bought or their two rental properties that they owned
Yep.
increased an incredible amount. I mean, even in
Yes.
GoBundance that we're in, which is a community that requires you to have a seven-figure net worth to be in it. I mean, we're slightly beneficiaries of this as well. The main
Mhm.
reason we're able to hit that, especially last year when we did, was because the properties we owned had appreciated so much.
Yep.
Now we've bought so many other properties at a discount. We're at several multiples higher than that.
Mhm.
But I mean, there's a lot of people in there that literally the only reason they have a seven-figure net worth is because they bought like three houses in Denver in
Right.
like 2009 and 2010 for 250 grand, and those houses are now each worth $800,000 a piece,
Yeah. Well, and
right?
that speaks to the fact that people who own assets, regardless whether you think that they deserve to be a millionaire or not, people who own assets tend to do better in inflationary periods.
Mhm.
And one argument I have is we're talking about inflation right now. It's 7%. I do think that inflation has been higher than has been quoted by the government the
Oh
last
yeah.
7 or 8 years. Their CPI index I don't trust as much as their basket of goods. It's because sure, an apple cost the same in 2013 as it cost in 2017, but
Mhm.
guess what? Your house didn't, your car
Yeah,
didn't, right? The
I
major
know.
expenses in our lives went up a lot, and that to me is indicative of inflation.
Yeah, I mean, it's always so tricky. You never even know who to trust with the stuff like that. Because of
Yeah.
course, the government, they like, especially with how the elections work and how
Hmm.
everything's so emotionally driven and stuff these days,
Yep.
they're gonna say what people want to hear to get votes. And since
Right.
we have an election year every 2 years, they're gonna say what
Yep.
people need to be told in order to vote for them,
Right. Right.
especially all the middle people. And I mean, I don't know. When it comes back to housing, though, so I found this graph. Looks like it's also from Fred.
Yep.
If I just Googled it and found it really quick, because I've heard this before. How do so it's a little bit hard to see on this tiny screen. Can I zoom in on it? Yeah.
Yeah, there you go, buddy. Ooh,
So
yeah.
this is housing prices, and the gray things are recessions going back to the 90s. I've seen other ones back to like the 70s, but this is what housing prices did during recession. So like early 90s, they kind of stayed the same. This one, they continued to go up. The only one they've dropped down was 2008 to there, and they've continued to climb. So whether this is going to repeat again, and I've seen a similar graph like this that goes back to like the 70s, and
Yep.
same thing, houses either stayed stagnant or they
Mm.
increased in every recession.
Right.
And they didn't necessarily dip at all. And I think a huge reason for that, we said, is just people not moving. And I think one of the biggest things that's going to change this year, like you mentioned before, people sitting on so much cash. I mean, a lot of the people that are doing okay, they're going to be able to ride out whatever things come into effect. Because the reason
Right.
the housing crash happened in 2008 was because there was so many people that overextended themselves and couldn't afford the situation they got themselves into, mostly because of the faulty lending practices that were going on. Which
Right.
don't
Yeah. They were
really
getting
exist
80%.
anymore.
They were getting 80% loans with 20% down payment loans at like a 9-10% interest rate. Right.
Yeah,
They were doing
with like 5-year adjustable
five-year
rates, like
five-year
balloons.
arms. Yep. The 5-year
Yeah, like
arm was the one that just got everybody too. And
mhm,
the thing about 2008 was that was a housing crisis. That was what drove the economic downturn. And so like the early 2000s, that graph was the dot-com boom. You had people
mhm.
getting overextended in tech stocks that were way overvalued. And that's what we found, and it popped, but housing wasn't affected necessarily. And so back to 2008, all the mortgage-backed security issues, and that was in some senses a market crash. But the reason it was crashed was because of the mortgage-backed security issues, right? And the
Mhm.
interesting thing is now we do have a mechanism to buy those back. The government does, to help with that, right? So they like to buy basically shitty securities from these banks, and that's how
Mhm.
they infuse cash into the economy. That did not exist pre 2008. That was a
Mhm.
mechanism. Probably at 2 a.m, the Fed team was sitting together and like, we have to
Right.
save the world right now. What are we going to
Do
do? And
something.
and I
Yeah.
don't typically give the government props, but I give them props in that case because they created a mechanism to do that. Now what they've done is leverage that mechanism to the T, and we printed like 40% of the like money in the history of the US all in during COVID.
Yeah.
So now they're overextending that, and of course we're seeing the negative effects of that too, with just broadly with inflation and other issues. But like that was a pretty cool tool that they figured out to save everybody's asses.
Yeah, I mean, yeah, and that's always the challenges, especially with the government. I mean, just again goes back to election stuff. I mean, it was in 2020, it was presidential election year. Like they were all just trying to make sure things didn't go completely sideways in a situation where I don't know if the world's ever frozen like that before. Where
No,
like
no,
literally,
of
I
course not.
mean, you think like thinking back to that really weird period of time when it all started. I mean, I remember seeing videos of like coyotes in freaking New York City because there was no people on the
Nobody.
streets.
Right.
You know, like
Those are
that's
actually rats the size of coyotes.
right, probably.
New
You
York
know,
City
just like
rat.
weird stuff. So
Yeah.
they needed to keep people's lights on.
Yeah.
Um, but and then as it like moved out of that, it got super political and you don't really know what to believe anymore.
Yep.
But I don't know. I think big picture though, what it comes back to is, I think we will head to some kind of recession here very soon, but I do not think personally that housing is going to take a large dump, specifically not like we saw in 2008. I think there might be a slight correction. But like in a correction being, I don't know, I wouldn't be surprised if we saw like a 5, maybe like 10% drop in prices.
Mm,
But even then, that will only be for, in my mind, like high end real estate that's already kind of
right.
unaffordable. I think that the consumer level real estate and like the first time home buyer price range, there's still just such a huge demand,
Yes.
even with the high interest rates, because it honestly is affordable to buy,
Hmm.
even at 7% interest to buy a $300,000 house for a
Right.
working a family with two incomes.
Yep.
And I don't think that that's going to be an issue. I think it's like luxury real estate, $1 million homes, things on like the super high end of the um, price point in any market are the ones that are going to take a pretty big dip.
Yeah. Yeah.
But it's like,
And that's maybe right. I don't know that
maybe,
that's the
yeah.
case.
But
What I
at the
would
same
do.
time, those people are probably also sitting on a lot of cash. It's only going to be if they try to move them, they're not going to have very many buyers.
Well, and everybody that owns a home right now is like a
Hmm.
housing expert, right? They might have, but they likely have more value in their home than they do the stock market, right? So
Oh yeah.
they're the only stock market investing they do is maybe through their 401k or IRA or whatever.
Hmm.
So what I would do is ask people, go look at other inflated assets.
Yeah.
Do you think any of the FANG stocks, are inflated right now? Because a lot of people say not a FANG stock, but like
Tesla.
Tesla's super inflated.
Yeah.
I would argue that they're not, because I think what they're doing is bigger than making cars. But there is
It's
there's still
worth
fun,
more than the entire car industry, bro.
right? But if you look, I don't want to go down this Tesla because I'm not an Elon fanboy, kind of am, but like at the same time, what are they doing? They've completely revolutionized the car industry. They took things that were mechanical and turned them into software.
Yeah.
And the data that they're getting from those cars out there is so much more valuable than the cars themselves. So I think
Yeah.
long term, I'm long on Tesla. Yeah, they might see a dip or whatever. And maybe they are inflated in today's market, but there are also other equities where people couldn't lose. I mean, if you
Mhm.
invested in Apple, you couldn't lose, right? And it's
Mhm.
just gone
Yeah.
up and up and up and up and all that sort of stuff. But there's also a ton of startups out there. And if you listen to like I like listening to All In podcast, they're big on startups and investing in those private companies before they go public. There's a lot of dudes out there. Well, a lot of startups that were built burning billions of dollars because they had these crazy overinflated valuations and their burn rates were massive. And they don't exist anymore
Mhm.
because they're overinflated. And there's
Yeah.
billions of dollars out of the economy getting pumped into those because everybody wants to be on that next startup wagon right before they go public. They get the sweet spot in the valuation, and then they go public, and then they sell out and they make a shit ton of money.
Mhm.
Well,
Yeah.
that didn't happen for a lot of those companies.
Yeah, well, and I think what you said there can connect really well to real estate as well, because talking about the larger vision of the companies and stocks, the ones that are going to keep doing well. I mean, the same can be said for real estate, right? If you're buying houses, you're buying real estate in places that people are moving to, are growing
Mhm.
economically, have a general demand within their market for people that are like moving there,
Right.
right? And not just investors. That you're probably not going to lose in those situations. It's when if you're buying like the really crappy properties, you're buying in quote unquote cash flow states that
Mhm.
no one's actually going there, and there's just the remaining people that haven't left yet, haven't figured
Yes.
out that they can venture outside of the green fields that they live in. Those are the people that are going to get bit,
Right.
and
Or
or like
you're buying at market prices because you have
plus,
some
yeah.
niche business model where you're like, I'm getting $6,000 a month in cash flow instead of the typical 1,500, but it's so niche and one little blow of the wind can take that away from you. Now you have
Mhm.
an upside down asset that is not cash flowing and you're losing $1,000 a month on.
Yes, that's also super valid. If you're doing,
Yes.
anything that's way outside the norm or super
Yep.
unique, that's another conversation we can have in a different video
Right.
about why
Let's
I
do
think
that. Yes.
Airbnb is a bunch of BS.
Right.
But
And not just Airbnb, other models, because some guys do
yeah,
great with that. Some guys and gals do great with that. But it's that idea of I don't care what I pay for the asset because it's going to cash flow great.
yeah, right,
Yes.
yeah. So ultimately, I guess looking at the bigger picture, back to housing stuff with the recessionary things, recession's definitely coming. I don't think that it'll affect housing that much. What I do think that it will do, I actually think the big thing will be just a ton of societal pressures,
Mhm.
because the haves and the have-nots are going to be further spread apart than ever before. Um, but I think that if you're on the lower spectrum of that, you're in the have-not phase right now. There's nothing wrong with that, but I think very realistically, it's going to be more challenging to get up into those higher
Mhm.
um, income brackets and the higher wealth brackets in the very near future.
Yes.
It's not going to be impossible, but you're going to have to work a lot harder for it. And the people that are at the top, honestly, they're probably going to be able to stay there okay, assuming that they're in hard assets.
Yep.
Because I mean, honestly, they hold a lot of the cards right now,
Yep.
and there's going to be less opportunity for people to build wealth for themselves and their families. And what that looks like over the long term, I don't know. Um, you know, there's a lot to be said about when that happens in societies, about how that affects the culture and how that affects society as a whole. But
Mhm.
you know, I don't think there would be like regulation around it, because I hate to break it to you, but all your politicians are rich fucking assholes.
Yeah.
So
Yeah.
and they
They
really
have
don't care about you. So
they have literally laws that allow them to be insider traders, which you and it would be illegal to do that.
I know,
So
right?
yes.
So, I think the biggest piece of advice I would give for people is find ways to generate as much of your own money as you can without relying on other people, without
Mhm.
relying on other businesses. Even if you have a job that you like, that's great. Just make sure that you have ways to elevate your income outside of that, because that's going to be so important if you want to go to the next level. Otherwise, the elite are going to kind of keep holding all the cards, and as the smart money keeps investing billions and billions of dollars into houses, the prices aren't going to go anywhere until they say so. And they're just going to keep renting to you at higher and higher prices. So, do what you can to sort of get out of that zone.
Stop letting people strip value out of you for their own profits and go strip value out of something else for yourself.
Exactly. And just do anything you can to have a skill set that's valuable to other people, and see if you can get some of those higher income individuals to pay you for it. Because that's what you got to do. So, but anyway, I'm not worried about housing. The whole thing is very unique. And I will say, though, as a millennial, I'm looking forward to a time where we can stop having things for the record for the history books every 3 years.
I know, right? Holy smokes, you're absolutely right. Our
constantly.
whole life.
I don't know if it's been like that forever, but I feel like every 3 years, it's just this is the craziest thing that hasn't happened yet. How do we respond? It's I don't know. So cool. All right. Well, thanks everybody. So our thoughts on housing, and if you do find yourself in a situation where you overpaid for a house and you need to get out of it, give us a call. We'll buy it.
Yes, we'll buy it. Yes.
So, all right. Thanks.
All right. See you guys.
Thanks for listening. Please leave us a review on iTunes or wherever you get your podcasts. And check us out at collectingkeyspodcast.com for tips and guides on starting your own real estate investment and wholesaling business.